Welcome everyone to Glion's webinar on post-COVID-19 real estate investment strategies. My name is Andri Rabetanety, and I am a real estate finance and investment consultant. My role is to help fund managers raise funds, execute transactions for direct investors, and structure innovative investment funds. Today, I would like to talk about how to navigate these unprecedented times within real estate investing. I won't be alone to do so. I have the pleasure to be joined by Mahdi Mokrane. Mahdi is the head of investment strategy and research at Patrizia AG. He is responsible for building well-established research and strategy skill set for core, value-added, and opportunistic investing in European markets. Before joining Patrizia, he was head of European research and strategy at LaSalle Investment Management and AEW Europe before that. And he also had the position of Director of Research and Training at IPD France. Mahdi is also a visiting lecturer in Glion for the Master in Real Estate Finance and Hotel Development. So thanks, Mahdi, for joining us today.
A
As,
pleasure.
as food for thoughts, I would like to set the scene with a short presentation. This will serve as a basis to kick off the discussion with Mahdi, who is the leading expert we are going to learn from today. This presentation will equip you with the basic key factors to consider for real estate investment strategies. At the end of the session, we are going to open up for Q&As, so save your questions while we are talking. You can write them down on the Q&A section, and we are going to address them at the end. So to structure my presentation, if I go to the next slide, I use the analytical framework that divides the real estate markets into three functional interconnected markets. You will see at the top the space market, where space is offered for rental. You would have at the bottom the asset market, where properties are bought and sold, and the development market on the left, where properties are constructed and sold. This framework is especially useful to understand how an economic shock could negatively impact the ability of an occupier to pay its rents, and to understand how a financial shock can generate new investors' expectation, leading to lower sales or lower capital values. And those lower valuation could constrain the development margin, which will prevent the launch of new real estate construction. So from this framework, I developed some hypotheses that I'm going to present now and focusing on the space and asset market that we will later discuss with Mahdi. Starting with the space market. So the COVID-19 outbreak took the world by surprise at the beginning of 2020. To bend infection trajectories, many economies have been taking sanitary measures ranging from public event bans to strict population lockdown. As those measures show positive results, some countries have reopened shops with social distancing measures still in place. But the strategy of exit of lockdown remain uncertain, and so are the implications of global economies. But I tried to lay down some economic effects we could assume in relation to real estate, of course. So those are in numbered the slowdown of export demand for China, the disruption of supply chain, the reduced tourism and business travel, the slowdown of economic activities, and the lack of confidence in political response. So if you think of rent as an indirect exposure to those economic effects, the occupier would be impacted in his or her abilities to pay the rent, but the impact will vary by asset class. So the different asset class are indeed affected unequally by the coronavirus, and the commercial real estate markets are likely to be more heavily affected than the residential market. So if I go into the details of the different asset class, you will find the office market, retail market, logistics market, which are more the traditional one, and more one example of the operating asset class, which are the hotel. On the office market, we might observe reduced rental growth and or increased vacancy rates due to pressure on profit and cash. But at an aggregate level, this could be offset by the dynamic, the microeconomic dynamic of the location, where the supply and demand are tight, especially in prime locations. On the retail market, we might observe increased level of default due to lower level of footfall. The occupier in difficulty before might not weather the crisis. The logistics market, however, might be the asset class benefiting from the crisis on the back of the growth of e-commerce. In response to supply chain disruption, companies could set up logistic networks, minimizes distribution costs, distribute products faster, leading to more onshore manufacturers. And when it comes to operating assets, such as hotels, we might also observe increased level of default due to the lower operational activities, especially for hotels relying on international visitors and conferences. So what is the key factor for the space markets? and that is the rental growth. With the expected contraction on the global GDP growth in 2020, rental growth will be hampered. As a result, we might see some impact in the updates of real estate valuations by professionals. Another indication of impact of rental growth is the negative correlation we observe between high yield corporate bonds, so debt, corporate debt, and commercial real estate rental growth rates. If the corporate bonds continue to increase, as we see, we would expect rental growth rates to slow down or even turn negative. Let's take a look at the asset market now. So we covered the space market. Let's look at the asset market now. So the first place to witness any changes in the capital market is the listed real estate sector. So listed REITs, real estate investment trust. As we've seen, they're not immune to the widespread market sell-off affecting all asset classes. And you see here examples of leading listed REITs on their own asset class. So you see Boston Properties for office, Unibail-Rodamco for retail, and you would see the impact around the time of coronavirus on their share price. So that was the first area where we could see a direct impact. And one could wonder whether this could spill over to the unlisted real estate. Although it is difficult to observe it yet due to the lack of transparency in the industry, we might look at studies that shows that stock market correlates with commercial real estate market values with a lag. So where are we now? We are at the moment in a price discovery phase where we might see repricing and the related decrease in capital values on the unlisted property market. If we look at the volume, we can lead on data from RCA that are showing, the very updated one for May, are showing a significant slowdown in deal count compared to previous year. So we see there an impact on the general volume. So we've seen the listed market, the unlisted market. Let's continue with another investment strategies and look at private equity real estate funds quickly. So you will see here, open-ended funds are private equity real estate funds where investor could buy and redeem their shares at a certain point of time. There we might observe higher redemptions, especially for those funds where there would be an impact in their real estate valuation. So if their valuations end up lower, we might see people wanted to redeem their shares, getting out of their exposure. Managers, however, could suspend trading by activating some specific legal clauses, such as material market change, to prevent significant redemption queues and avoid having to repay those redemptions. Another important effect for institutional investors allocating money to private equity real estate fund is the so-called denominator effect. So when public markets fall in value, the weight of less liquid asset class such as real estate grows, and in effect, their real estate allocation could reach their maximum target, putting their allocation strategy off. So we might expect there some different behavior from investors who might rethink about their allocation. The key factor to observe on the asset market, there are two. There's the first one, the risk premium, which is the difference between the yield on government bonds and the yield on real estate, as shown on the left-hand side from Narich. You will see the dark line being the government bonds evolution and the other line being the real estate yield. So you see here, there should be a positive difference, and that's one of the yield is one of the main reason for institutional to invest in real estate. And we might observe on the short term, real estate risk premium reduce as government bonds yield increases, as the chart shows on the right-hand side. We see a government bond yield increase and real estate valuation taking time to adjust, the real estate risk premium in effect will reduce. The other factor that we need to look on the asset level is financing, because real estate is a lumpy asset class. That means you need a lot of money to invest into real estate. So financing plays a key role in accessing exposure. How would the bank react? The bank would probably reassess their criteria to give loans. The time to close a debt facility will increase, and bank will focus on smaller deals that they could carry on their balance sheets. Covenants will tighten so that only the players with the best track records will get financing, and we will observe also an increase in delinquency in the coming month. As a matter of fact, DBRS Morningstar, who monitors commercial real estate collateralized loan obligation, observed already an increase in delinquency rates and request for debt service release for hotels and retails. And in May 2020, they adjusted their probability of default up to 2 points. So with that, I just wanted to share a couple of thoughts to start from, and I will now hand over for Mahdi to get his initial reaction on those.
Thank you very much, Andri. So first of all, it's a pleasure to be here. I gave a lecture to the master's teams, students a few months back, just before actually I started this new job at Patrizia, and I was telling them, maybe I'll have a smooth start, low intensity, and just gradually getting into the job. And less than a month later, COVID-19, with the huge impact that you all know, came into action, and really I had to be full on with my team. And I'd like to share with you a few thoughts, a few observations, and maybe supplement and nuance some of the themes and implications that Andri has pointed out, and maybe give you some underground sort of examples of particularly resilience, or the ability for some asset classes, some locations, the nuances we're seeing on the ground as we look into our portfolios, raise capital, and keep the business open at Patrizia. So just a couple words before I show you a few pictures and a few slides. First of all, I'm working for Patrizia AG, which is a listed entity. It's the largest independent real estate manager here in Europe. It manages about 45 billion euros worth of assets in an array of countries and an array of property types, using what I call the human capital, which is 850 people, staff, Patrizians we call them, working in 12 different countries here in Europe, plus our offices around the world, in Asia Pacific as well as in the US. So I think we started really looking at COVID-19 and its implications on real estate strategies back at in February, when we saw was then sort of something that was pretty restrained or located in Asia Pacific and China in particular, then move on to Iran, move on to parts of the Middle East, and then pivot gradually to Europe. And we anticipated that Europe could become the epicenter of a pandemic. And at that point in time, when we kicked off a task force. The task force within Patrizia, called the COVID-19 task force, was really aiming to do several things. First of all, get ourselves in order together to speak to each other as a board and as a leadership. Protect our people, protect our clients, protect our assets. And we went on into a very specifically thought communication. The worst thing that could happen if you're an investor with a manager, if it's suddenly that investor goes blackout, no communication. And we do have a team that manages indirect investments. They're called the Global Investment Partners at Patrizia. So they invest in funds around the world in a more high octane sort of strategies. And they told us that from their experience, they saw really two groups of investors, investment managers, those that went blank and just disappeared or didn't give much in terms of way of communication, and those that really were hands-on, trying to address the issues, not shy away, not go into denial, accept what was going on, and plan ahead. First of all, level one communication, which I was heavily part of with my team, to put together a slide deck that we could explain and discuss with investors, not think about trying to answer all the questions, because we can't do that. We're not, medical, pandemic experts. However, we can document ourselves and we can think in scenarios. That's exactly what we did. We call that level one communication, right? This is a high level, and what Andri just did, for example, is a typically great example of a level one communication. Level two communication is if you're an investor in a particular fund, you need to go into understanding, okay, what does that mean for my investment? What does that mean for this hotel fund? What does that mean for this retail fund? What does that mean for this residential fund? So we went down one level to discuss the implications of our scenarios and our stress testing on each individual fund, given its different nature. Could have been a mature fund that's not investing anymore, a fund in ramp-up period, or even a fund in capital raising period, and we're already assets in place and some investors in place and discussions ongoing with a number of other investors. So that's the level two. And level three is if an investor wants a particular conversation, either to deep dive into an investment exposure or because that investor is invested in a number of funds and want to have a different kind of level of communication, we can do it on a one-on-one. So level 3 communication is really one where a fund manager, research and investment strategist like myself or someone in my team would go on a call. We used so many Visio conferences, so we adapted. And then the task force also helped us get ourselves organized. So, for example, very practical things, checking that everyone was safe and healthy, checking that you had the right equipment to be back online as quickly as possible to work effectively. We actually changed some of our IT tools and expanded them to have various sources of communication using, for example, Microsoft Teams. We could use Zoom, WebEx, and other means like Skype to communicate. So communicate extensively. That's one of the key things we did to check on people and make sure we had the right information sharing. We also instigated specific sort of forums where team members, leaders communicated on what they were seeing on the ground. So for example, I would give an update on a very regular basis, bi-weekly or, twice a week, up to twice a week on where I was seeing from a top-down perspective. The head of transactions would come in and say, these are the deals we had already lined up. Here are some of the issues. We're closing on them, selling or buying. Capital markets would talk about their conversations with investors. Asset managers would talk about rent collection. End of February, end of March, end of April, and now we're looking at end of May, early June, and calculating the rent collection as a percentage of in a comparison with a year before. So we did all of these things, and we also brought in our corporate finance team as well as our investment relations team, and we looked at what was going on also for our share price and the way investors were looking at us as an ongoing concern. And broadly speaking, one of the key focus areas is we want to be the #1 investment partner for a number of big institutions around the world. So we have 600 million on our balance sheet of available cash. So we could be, looking at the market in a pretty proactive manner and acquiring market share because we think we have a very strong balance sheet and a very resilient business. So having said that, this sort of sets the picture of what has been really our main areas of focus, keeping our people safe, making sure they're all really well equipped to continue, that business continuation is in place. We delivered screens and chairs to people in their homes so that they could be comfortable, and because we knew they would be spending hours in front of their screens, which is the only way to really get that communication going. We checked on internet connections, and some of our offices got closed and locked down, but others, say for example in Germany, we still continued on a 50-50 sort of team A, team B rotating basis, so that not everyone went to the office, but you could go to the office if you were part of a team that rotated in the office or rotated out of the office. So really, I think it's both a very high level macro view and a very sort of practical, getting things done. One of the things we realized is that some of our investors came back and fed back about the way we did things and compared with some of the, the others in the market. And frankly, some came pretty unprepared. And one of the key things, I guess, that made, the transition from a shock to something that you get accustomed to is the fact that Patrizia had invested for a long time heavily into tech. So Patrizia has a specialized sort of team and part of the business that really invests in real estate tech, whether prop tech or fintech. And we've continued actually acquiring businesses around the world, either around things around businesses like WiredScore that really link to measuring the ability of buildings to be connected to the wider sort of quality of the internet, all the way down to the Internet of Things, all the way to sort of trading of assets through digitalized ways and means, and investing in tools is something that our chairman truly believes that this is going to be one of the key things that will transform the industry. So let me now just maybe, I don't see if there are any questions. Let's make this as interactive as possible. Please feed through the live Q&A, ask any questions, and whilst we wait for some interaction, I'll just go through a few slides of a deck that we've put together and that we're speaking to investors about. So, Michael, I don't know if we could go to the presentation. If I could share my screen.
Sure, just go ahead and share.
Yep. Can you see my screen, all of you?
No, not yet.
Oh, okay. So maybe let me do this. Here we go. By sharing the screen. Yeah, I think that should work. How's that?
Yeah, I can put that up.
Yep.
Okay, great. So I won't go through the whole slide deck, but I'll just show you how we've approached this, very, quickly and swiftly, and just pause on a few pages that really echo what Andri has just mentioned in terms of, COVID-19 implications and, implications for investment strategies. And I'll pause at the back end where we see our, longer term view of sectors. So, clearly, one of the things we focused on, and some of you may have seen these charts, these are stringency and timing of government responses to COVID-19. As you could see, many of the European countries have put in place some of the most stringent, lockdown measures around the world, comparable to, say, that of China. And Italy and Spain were really at the top there. So the higher you are on those bars, the more stringent the lockdowns are. But luckily, we're now gradually easing those lockdown measures, day by day, week by week. And then, of course, this slide is interesting because on the left-hand side, I think this is really a key point. It's extremely difficult to forecast GDP in the current environment. This is an unprecedented event. And if you look around and survey, even very seasoned, economic forecasters, they'll give you a different array of numbers. This is just a case of the UK, and you could see on a quarterly Q2 and then full year, you could be as optimistic as a sort of -5 or -3, like JP Morgan here, for example, 3.6 in the middle of the graph. But you could be also a very negative, taking a very dim view of the economy here in the UK for this year, all the way down to -12%. So the whole array of forecasts is just, mind-boggling and amazing. We're sort of a partisan of a U-shaped recovery, recession and recovery. We're not V-shaped, maybe with the exception of a couple of countries here in Europe, such as Germany, where we think it's going to be more V-shaped than U-shaped. We're not L-shaped, but clearly we're not as negative as say the likes of capital economics or some others. But we're clearly not as positive as the -3.6 that you see here, for example. So we've used a number of scenario testing. This is one we've borrowed from McKinsey, and we've sort of positioned ourselves around, an upside, base case and a downside. And this is what I was talking to you about when I mentioned level 2 communication and level 1 communications, telling our investors, we have to be humble here. We don't necessarily know what the shape of the future will be, but we can model it, and we can tell you with each one of those scenarios how your performance is going to be in each one of those. And that's really something that is extremely helpful for investors. Then they can anticipate whether dividends will be distributed, whether equity will be needed or not, whether they're going to be acquiring assets or not acquiring assets as fast as we anticipated, et cetera, et cetera. So what we've decided to do is, we probably know and are better informed to know whether the interventions of governments, that have been rapid and massive will be efficient or not. We think they're going to be partially effective. So we've ruled out the left-hand side and right-hand side. We know they're not going to be highly effective, and we know they're not going to be, poor. However, it's very difficult for us as real estate investment managers to be able to say, oh, we know, the spread of COVID is going to be under control pretty quickly, or we're going to have a relapse. So we have to put probabilities around those three on here. So that's the way we've approached the scenarios. Let me just pause on this one. This one is, we got a number of questions from our investors asking us, do you think this is a repeat of the GFC? Is this likely to lead to a sort of a credit crunch and, a repeat of a financial crisis? So what we did is we looked at the left-hand side, looked at how the high yield indices, evolved compared to the GFC peak. And we've looked at how the Euro large cap AAA or A rated, bonds were compared to, say, the GFC peak or even the Eurozone crisis. And on the right-hand side, we looked at the way banks treated each other in terms of interbank lending charges. So it's the so-called TED spread. And the TED spreads did increase significantly, particularly in the US, not that much in the Eurozone or the UK, but they did put some stress in the system. But again, by no means comparable to the Eurozone crisis, and let alone to the GFC in 2007, 2008, 2009. So what we're looking at here is more a corporate credit quality sort of crisis, where even some of the better rated bond yields peaked at nearly 200 basis points for triple B and double A rated bonds, but in no common sort of measure compared to where we were in the in the GFC, but to some extent comparable to what we had, but to a lesser extent during the Eurozone crisis. So that's something that is very important. So banks will be on the back foot, but they'll still continue lending, and you could see we can monitor those lending activities by banks because they're the main providers of capital here in Europe compared to, say, the US, where there's a more diverse source of debt capital in the market. And Andri mentioned the CLO markets. We don't have really a CLO market here in Europe. So that CLO market may have shut down or be under stress in the US, which is not great there. But here we heavily depend on banks and, to a lesser extent, private lenders through debt funds, for example. So let me just jump to another slide, which I think is important. So this gives you the depth of the expected, sort of recession in a number of countries in Europe and compared to China and the US. But probably more importantly, it's this slide here that is more important. And why is it important? Because it gives you the magnitude of the recession that is expected in a base case scenario, but it also provides you with some of the key components of GDP that are key. The blue lines here represent investment activity from corporates and the government. So the overall investment activity in the economy. And you could see it's actually being dragged down pretty strongly. However, look at the other component of GDP, which is the unemployment or the employment levels. And clearly, you have some countries, particularly in the northern parts of Europe, say Germany, Austria, to some, the Netherlands, Sweden, even Denmark, where the impact of COVID-19 is going to be pretty minimal on the job market. So the way the COVID-19 is going to play out is going to be through either consumption or investment, but not the job market. However, if you look at countries such as Italy and to some extent, France or Spain, the impact is going to be much, much larger. And the UK, for example, is the one that is going to be one of the worst hit in terms of its employment or unemployment levels. So that helps us think about what happens with the recovery, because we believe that it takes longer to recover once you've shed jobs. And if the job market has been hit severely, it will take a shallower way back to recovery. This is why we're more believers of a V-shaped recovery in countries such as Germany, because you can resume your investment activity and consumption quickly if the job market has not been hugely affected. Conversely, in a country such as Italy, we think it's going to be shallower because that could recover in terms of investment, but recovering on the back of having shed a large number of jobs is more difficult and lengthy, and that's historical evidence points to that very clearly. And then just echoing one of the I think mentions that Andri focused on, this is the same kind of analysis, but we're putting it in a different perspective. So what we've done here is looked at price changes in the REIT market, listed real estate across Europe with a specific focus on the colors. Right-hand side, you see a lot of orange. These are shopping center, retail exposed REITs in Europe. And they've been dramatically affected by COVID-19. Shutting down a huge shopping center is an awful thing if you're a shopping center owner and manager. So the likes of Hammerson, Unibail-Rodamco, Klépierre, Deutsche Euroshop, they're suffering extensively from this crisis, and simply because they're getting very little sort of rent collection on their assets. And then you find the sort of this is one of the only here in Europe sort of more hotel oriented. So Covivio is not 100% hotel, but it's a good proxy. So it's less affected than retail on average, but it's probably certainly more affected than those deeper bars, which are either diversified or mainly office listed real estate. And then you have the student housing, which sort of more or less in the same bucket of impact of COVID, compared to the mainly diversified office exposures. And then you have the two sort of winners in this environment, which are on the one hand the industrial logistics sector, which is benefiting from huge sort of online sales, and then on the left-hand side, the mainly residential. So residential is one of the key winners in this environment, and that's also one of the reasons why investors see Patrizia and as a residential specialist. Patrizia has been doing residential for the last 35 years. We do it into all risk buckets, from super core, value add, core plus, to all the way to opportunistic, develop and sell. And we manage about 11 billion of the 45 that I mentioned earlier in just that multifamily asset class. So that has been perceived as a very resilient sector, with rent collection, nearing the 98-100% sort of mark. Diversified real estate, probably in the 80, 85, 90. Student housing, probably 50 and lower. And then if you look at the retail, sectors, probably 30 and lower. And hotels, it's very varied depending on countries and operators, but you could expect to be broadly in the same ballpark as retail and shopping centers. So I think what I'll do now is I'll very quickly jump to this slide, which gives you a high level sort of view of the way we're approaching the different strategies and sectors. As I just mentioned, residential is for us both short-term and medium-term. If you look at the demand, supply, and balance, a very resilient sector. It's arguably low yielding, but every single prime sector today is low yielding in Europe. If you take prime offices or prime logistics, they're arguably pretty low yields throughout. And you can even find some good quality core residential that is higher yielding than, say, prime offices in the main office markets of Europe. Logistics, very clear winner. Not all logistics, because if you have a tenant that is exposed to retail, say a furniture shop and you're managing their stock through a logistics shed, then they may be in trouble sort of paying all the months since the month of March. But longer term, we have accelerating factors that will push this sector forward. Offices, sort of the middle of this. Student housing could really be tricky for the next year or so, depending on the easing of lockdowns. And we have a number of universities that are announcing that they'll still maintain online courses at least through the winter, and maybe throughout the whole year. A handful have announced that. But longer term, we think this is a good sector to be in, so it could open up interesting investment activities for the higher octane strategies. Food retail is the one sector, convenience, food anchored retail has done very well over the short run, and we expect that to continue with one sort of caveat that we've seen increases in online food retail with cold storage on the up, which has led us to sort of maybe downgrade a little bit that longer term outlook for food retail, despite it having done very well in the immediate past. And then comparison retail, which is fashion and anything you can compare with online, is really tricky today, and it's expected to have headwinds and structural headwinds going forward. Hotels is a different approach. We think short term, very difficult, and we have a small hotel fund, and rent collection there has been pretty low, but it's mainly exposed to the northern parts of Europe and Germany, so it's already recovering, particularly led by business travel. And business travel is actually picking up again pretty strongly and rapidly in the main cities of Germany. It's a polycentric country, as you all know, so you have to travel. And longer term, we think it has the capability of bouncing back very quickly. That's why we've sort of put a green light in the longer term. Again, for our more opportunistic sort of strategies, we think this could be a good way to enter the market at a maybe low entry price and just ride the wave of recovery. Again, taking the risk of maybe a relapse into COVID or another such event, but that probably should be priced in and is already priced in. So with that, I'll just leave you with one little thought on the longer term, which is linked to urbanization. You may have seen, if you're really interested in the impact of COVID-19, that density, highly densely populated areas, which have been very much the success story of post GFC, post 2008-9. These large cities have attracted a lot of talent and have been growing fast in terms of inward migration and growth in GDP at a city level. These could be put into question because of two things. Transportation and coronavirus. If the pandemic does not really disappear totally, so heavy traffic and heavy transportation systems could put an onus on living in a big city, and the working from home. We've all discovered that you can be very efficient working from home, and if offices and office decision makers say you could work from home on the basis of 2 days a week, then it could open up the ability to live further away in a suburban location with a good school and good environment and better air quality, etc., less public transport jam, or even in a secondary nice city, call them 18-hour cities, and commute to your workplace on a 2 to 3 day basis. And if that would be the case, then you'd certainly have a very different way of looking at your real estate strategies going forward. But that's food for thought and food for discussion. And with that, I'll stop here, and Andri, let's go for discussion with our listeners.
Yes. So let me check if we have any question. I don't see any question. Please, for those who listen to what we said, do not hesitate to send some questions to create a debate over all the elements that we said. But I just want to take also the opportunity to thank Mahdi for describing how Patrizia, such a large real estate investor, remain open for business. So the leadership that you took, the leadership approach that you took, with the different level of communication is and setting up a task force for COVID-19 is quite interesting in terms of how such a large industry player managed to weather through the crisis. Also, thanks for putting some example about the questions that the investor had, how do you address them, how do you address the allocation in different asset class geographies, and also the strategies you might see short term and medium term. While we wait for a potential question, I'm going to jump on one thing that you said, because we talk about allocation on asset class geography. I want to also talk about in terms of different strategy, core, value added, and opportunistic. You did mention that Patrizia had a strong balance sheet of 600 million available cash. That calls for maybe being ready for some more opportunistic. Blackstone, which is one of the largest real estate investment manager with $160 billion asset under management. So the president of Blackstone, in their earnings calls on April 23rd, 2020, said that he did not expect any opportunistic deal in direct real estate to come up for at least a year. Because some of the owners has to live through some of the cash. I'd like to hear what's the thinking there. Do you see going more into opportunistic, or the allocation between the different strategy, so core, value added, and opportunistic, would sort of remain the same after the crisis?
Sure. Just one sort of little addition. So the 600 million euros that I mentioned is on the balance sheet of Patrizia as an investment manager.
Okay.
In addition to that, we have dry powder in our different funds, which amount to multi-billion sort of dry powder on behalf of our investors, and we have dry powder in virtually all of our investment pools, from our pan-European core fund all the way to our residential fund, as well as our more opportunistic Trans 7 is a trans-European fund series. So I think today if you look at our strategies and the way we consider core, value add, and opportunistic, I guess it's a more barbell. You know, if you take a very look at the very core end of the market, we think it's probably easier to underwrite deals there than in the higher octane strategies, right? So if you have a core mandate, and we've continued investing, so we stayed open for business, so we closed deals, so we're already in inception before COVID-19 outbreak, and we also initiated a number of deals that we will close once we are able to actively, visit, underwrite, and do our due diligence in the core space. So we bought offices, we bought residential, we tried to chip prices, we also sold, our buyers tried to chip a bit prices. So, I think that discussion and market has stayed very, very open. Now, if you're looking at a core plus or slightly value add strategy, it's more difficult. Why? Because you have to take a really clear view on where prices are going to go over the next quarters and where rental growth is going to go over the next quarters. So if you're at a core plus, you're probably going to stay slightly away from the sort of, comparison retail, because it's quite difficult market today. You look at offices, for example, which is the main food group, and forecasting office rents today, if you're going to go into a refurbishment program, it's a difficult one. So that one is probably going to be slightly on pause until we see more clarity. And then if you move to the higher octane strategies, then this is really about making money on the way in. So if you get a deep discount and you take a view on a portfolio or a sector or a geography, then you can be confident that you've discounted the price versus pre-COVID situation, and you've underwritten very conservatively a deal, and you're putting very modest, say, leverage. Then you're banking on the upside, but you're not wholly banking on it because you've made a lot of your money or your return on the way in. And that is still very active, and we're looking at platforms. And this is an area where we could be active both on the propco business, buying assets, as well as on the opco, and use our balance sheet. So as an illustration, we are looking at operators in the flexible office space in different countries, people that have a really good platform but are struggling today. We are also looking at developers, so you're actually buying a business that can build the future residential or office market in a certain city that we like and understand very well. We are also looking at healthcare operators or operators in the student housing universe. So these more operational types of assets are the ones that are suffering the most today. But for some of them, we have a very positive long-term opinion of the sector, and that's more higher octane. So in all, core still active, and investors need to deploy and need the cash. And as you said, the risk premium is still very generous. Higher octane is super, opportunistic, still very active, but the idea is to mix opco and propco. And in the middle, probably more on pause.
Okay, thank you. Since you're talking about operational assets, we have a couple of questions around the hotel funds that you have. So I'm going to bundle two questions in one. There's a question around the change in strategy, learning from what happened on COVID-19 in your hotel fund. So in the future, would you have a different approach? I don't know how currently the hotel fund structure, whether through lease or hotel management agreement, but the question is, in the future, would you change that approach? If it is lease, then go hotel management agreement. If it is hotel management agreement, going for lease. And the second question is, which type of hotel would you go to? You mentioned before that the one with more the linked to the travelers would be more impacted. So maybe you would see more recovery there first once people are again able to travel.
Right. So the hotel fund that we have today is one that had been structured and tailored for a pool of German investors. And some of you may know that German investors, for a fund to be eligible to their real estate quota, they need leases. So the hotels that we had by nature of the strategy were leased hotels. right? So in that instance, we're very pleased to have leased hotels because as long as you have strong operators and many of our operators continued paying, or we found an agreement for them to delay or stage or stagger their payments throughout the lease term, so we know we'll be paid, and we have to sort of find a win-win agreement or avoid losing agreement whereby they commit to continue paying, or we find other sorts of agreements because real estate is complex. And for example, in one case, we have a very strong brand, and but they were suffering in a specific market, and we came to the agreement that we were supposed to do a lot of capex at a point in time. So we agreed that we would delay that capex, or they would pick up part of the capex in the future and relieve us of that obligation, in exchange of which we relieved them of some of the obligations for paying short-term rent. So I think we will still have a preference for leased hotels as long as the pricing is right. So that fund was essentially developed when the pricing was right. Now, in terms of taking more operational risk with a sort of management contract, or where you take more sort of flexible income, we would only do that in the strongest market. We would only stick to the very, very strong markets to do that. In terms of geographic mix, we still very strongly believe in diversification, and we have a bias towards the biggest, largest markets in Europe. Now, as an interesting sort of opportunity that may arise, Italy is an interesting country from a macro standpoint. As you had seen, it is going to be hard hit. The tourist season is going to be difficult, and the hotel market there is very fragmented. So compared to a number of other European countries, the proportion of large operators, the Hiltons or the Marriotts, etc., the Accors, that proportion of market share is very low. So we believe that there could be opportunities there for us to come in and maybe buy an asset or a portfolio and reflag those with leading brands or successful boutique brands.
Thank you very much. Another question, more related to financing. I believe that you may have in your portfolio some assets where you use financing or use that as a leverage. Maybe you had some interaction with a bank. Can you tell us a little bit about what was their reaction, not specifically on Patrizia, but more generally on capital repayments, so release, debt service request for release, capital repayment holidays, and any facilities that they could arrange for having a grace period during those unprecedented times?
Hi, Andri. I think one of my connection went a bit bizarre, but I'm still online. Can you hear me?
Yeah, we can hear you.
Okay. So you were asking me a question on banks and financing.
Yeah.
So
yes.
You'll be a bit surprised in the sense that when COVID hit, the banks what we interacted with had really some hard time getting themselves organized. So the working from home was not as seamless as one would have expected, and simply because they're very complex organizations and not always 100% or equipped to work from home seamlessly and quickly. So that was one of the things that we realized, that getting the attention of banks was not easy. However, being a very large leading investment manager here in Europe helped us get that kind of level of attention, and really we were very pleased to see that it has been a success in getting access to the top level sort of leadership in those banks. Secondly, what banks tend to do, pretty much as when you look at it, when you have a portfolio of loans, is to focus on existing loans and service those and make sure they're actually not in trouble and need attention. Thirdly, they focused on the term sheets that they had already agreed upon and wanted to close and continue because they had done their underwriting, passed credit committee, and wanted to close. And fourthly, that's where things became a bit more difficult, and I think for everyone, is getting their attention for new business. Many banks were not and are still not open for new business, and that's one of the things that probably led to a increase in liquidity costs and more difficulty in getting higher quotas of LTVs. So in all, I think fewer banks active, but those that are active, prefer their, the investment managers that they, have been working on and trust and have a long-standing relationship. In terms of liquidity costs, they did increase a little bit. Sorry.
Can you hear me?
Yes, we can hear you.
Oh, sorry. I'm
Yeah,
probably back online now.
Yes,
So,
you are. Yeah.
Okay, great. So they really focused on their existing book of business, and for new business, they really focused on investment managers that they have trusting relationships with, and focused on lower LTVs. The liquidity costs went up a little bit, but the base rate went down. So all in all, our experience has been that the funding costs have stayed relatively stable over time.
Yep. So another question also related to not bank but more to loan strategy. There's one last question due to the time regarding whether Patrizia would be interested into debt fund, and especially when relates to some distressed hotels where they could be helpful for them to foreclose on their non-performing assets. So is that something that Patrizia would look at?
So as a sort of a real estate investment manager, we like many large real estate investment managers, we have ambitions. One of the ambitions, of course, is to grow our global presence. So we have teams on the ground in all major markets and major continents. Initially through our indirect investment branch, as I said, investments in funds for a variety of clients, and through mainly high octane strategies. But we also truly believe that we should be a real asset manager, in the sense of we're also interested in infrastructure, and we think that when we go into healthcare infrastructure, when we go into lab science or science parks, or new emerging asset classes, we're a real asset. And then when we also are strong believers of the 4 quadrants approach to real estate, and in that 4 quadrants, there are 2 areas where we could be active. One is the listed, but it's a very specific niche market. And then you have the debt. And today, from a risk-adjusted perspective, we do believe both are interesting, but in terms of scaling up our business and developing our skill set and using our teams on the ground, debt is clearly a space where we could be active. Now, can that enable one to access deals in the post-COVID world? Yeah, I do believe it's possible. But today, we're seeing quite a few opportunistic investors, but not that many distressed sellers. But let's see where that goes.
Thank you very much, Mahdi. We're coming right on time to the end of this webinar. Thank you, everyone, for asking those questions, for the interaction there. Thank you also to Mahdi for joining us today, sharing leadership thinking from Patrizia on this post-COVID-19 investment strategies for real estate. So thank you very much for joining, and have a very good end of the day.